So tell me, we were talking a little bit off the air about the 5Ds. I thought that was really interesting. Thought maybe that's something you could talk about on the air, the 5Ds.
Yeah, what do you think they are? Let's ask what you think the 5Ds mean.
I'm gonna say
this is relation to a challenge for business owners, real estate investors, executives.
All right, I'll say one of them is debt.
Debt?
DEBT.
No.
One of them is depreciation.
No.
One of them is divorce.
Yes.
Oh, is that one? I got one?
Yep. 1 out of 7 so far. Go ahead.
One of them is diploma.
No.
One of them is diverticulitis.
No.
Okay, I'm out.
You're out. It was a good try, though. So death.
Oh, death. Okay.
Yeah, that big one. Disability.
Oh, okay.
And this is a challenge. We were talking about how, business owners, real estate investors they're not prepared for these things, right? And it can devastate the business and devastate their income, devastate their net worth, divorce, distress, disagreement. So
distress and disagreement. Okay.
Yeah. And 50% of exits in a business are not voluntary because of these things, right? You don't know when you're going to be disabled. Like the example we talked about in the last segment, my friend that had come in and was
healthy and
fine. And then got short-term basic dementia,
Alzheimer's
or whatever it was. But
it's awful.
Yeah. And
such a debilitating disease.
So the point is that, the owners of a business are leaving money on the table because they're not protecting the business, right? And because
they're not prepared, right?
Well, yeah, you don't think
none of those things that's part of preparedness, right?
Right. Yeah. Well, you don't think anything's going to happen to you because I'll do it later, right? It's like it's always the same thing.
Yeah, I'm too young to think about it now. I'll deal with that in 10 years or something. Yeah.
Right. When I get older, I'll need to really start planning for it, right? And so, there's a survey done by the Exit Planning Institute. It's based on the State of Owner Readiness Survey. And so 2/3 do not know all their exit options. 78% have no transition team. 83% have no written transition plan. And 50% have no plan at all.
Wow.
So most businesses are basically winging it, right? Real estate investors just winging it. They're just trying to make it the next day, get their job done, make some money, pay the taxes, be a husband or wife or a father or mother to their kids and go to soccer games and basketball games and live life. We're so busy. And then one of the largest part of it, the 85-year-olds, or 65-year-olds they surveyed, and 85% of their net worth is in the business.
Wow.
That's crazy, right? So it's 40% have no plan to cover the 5Ds, what we just talked about. So that's the goal of helping these business owners and real estate investors.
That's where the SEPA comes in.
Right.
Seriously, it's bringing the money out of the business that you put in.
Right. Yeah. Instead of just keeping it all in one bucket, you are taking so much risk. How do we extract that through tax planning, bringing on other people, so where you can extract some of the wealth outside the business and you're not taking as much risk. You're protecting it, right? You're protecting the value and then making the business more transferable, right? You can transfer it to someone else that sees value. Most real investors don't see a lot of value in a one-man show, right? Because they're like, well, this person has the relationship, all the customers and clients, and I'm not really interested in that, right? I need something that's going to be able to transfer. So, but the 5Ds are scary to folks because that it can destroy a business and it can destroy a person's net worth if you're the one doing it all, right?
I kind of feel like, and not to go back to the SEPA thing, but with all of your certs, I feel like your business card's going to be the size of a small Volkswagen. Don't you have a lot of acronyms behind your name now already?
So, the thing about acronyms, it's all about how you apply to it, right? So you have to use what you've learned and apply them. So trying to help, who has the most complicated situation? It's families that are running a business or manage a real estate firm, which is a business, but a lot of real estate, I say real estate investors separately because they act like they don't have a business. Yeah, I'm in real estate.
It's absolutely a business.
Oh, it's a business.
Yeah.
The IRS thinks it's a business. You may not think of it's a business because a lot of them are like sole proprietors. I mean, they may have LLCs, but it's taxed as sole proprietor. They're not paying stuff a paycheck. They're just kind of, not all of them, but some of them are not running it like a true business, right? Where there is some real estate investors that I know that do. I mean, they run it like the Marines. I mean, they got,
Militant, yeah.
Vice president, you got area manager.
Oh, the hierarchy, yeah.
Yeah, boom, 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 down, and they run it like a top, and it's efficient. And they're also making a great profit. So I think, zeroing in on where you have problems, we've hired consultants and the consultants come through and you're like, oh, I'm doing pretty good. And they start tearing you apart.
Yeah.
And you're going, oh yeah, I guess I know I could do better in that area. Well, yeah, I guess I could do better in that area. And it's constructive feedback that's encouraging because
What you're paying for.
right.
Yeah.
I know you're paying someone to tear you down.
Yeah.
But when they show the pro forma, which is the forward looking, right? Okay, if we make these changes, what this growth can accelerate at. Small business owners can accelerate at 30 to 40% growth consistently.
That's amazing.
I mean, I asked a business owner, he came in, he had a bunch of real estate that were doing really well. He bought really, really well when the market was down in 08, 9, and 10, when nobody wanted the real estate, right? So I said, and he had some good stock portfolios, some of them not so great, but he had a couple really good portfolios that had done well. I said, so what's the best performing asset you have? I mean, if you tracked it back 15, 20 years ago, because he said, I started with nothing. And he goes, I don't know. I think probably the real estate. It's like the real estate's done really well because I bought it really well and I got, cash flowing.
Bought it cheap. Yep.
And I got these commercial properties. They're paying me rent. It's very low maintenance. I'm like, oh, okay. I said, wrong. And he goes, what do you mean? I said, it's your business. I mean, he sold part of it already. So I kind of could figure out how much he started with and what he grew it to. I mean, it was over a 30% year clip. Like, where can you get a 30% annualized rate of return? And don't mention, I know Jake, our
Bitcoin.
Jake, our producer, is going to go, well, Bitcoin, Ethereum, yeah, crypto, which none of my clients want to own, right? Because they know the risk that's involved in it. I mean, yeah, they might have 50 grand in it or something, but they're not going to put a significant part of their wealth, which, the business, they feel comfortable owning it because they understand it. It's them. And so what if you can grow it faster than that, right? And protect it and pass it on to the next generation, get the children involved, maybe, start a succession plan so your kids could, get involved or so it's really not, it's trying to figure out if it's done so well, why wouldn't you want it to grow more?
Yeah. Well, and I've always heard the rule of attrition. You need to grow your business 30% just because of attrition.
Right.
That every single year. So let's talk about, and you've talked about this on the show with me before, and this is kind of a somber subject, but one of those 5 Ds was death.
Mm-hmm.
Have you had, and obviously I'm not asking for names, but have you had a client come in and have a death of a spouse, but yet kind of inherited the business and needs to know what to do with the business?
Yes. And it was a medical practice, actually, but not going to go any specifics on who.
Right.
But the doctor was a very prominent physician, doing very well, started declining. The spouse was not involved in the business, right? She was not at all. And they were dependent on that income. Now, thankfully, he had saved, he had extracted, he was a good investor, so he'd extracted a lot of the wealth outside the business, right? And he also owned real estate in the business, right? And he was buying land and just moving. He started diversifying, thankfully, early on. But what's the hardest part is their concern for losing money, because they don't really know what's going on. The other spouse that's not involved.
Right.
I just remember the conversation, and she looked at me in the eyes, she started crying, and she goes, Brian, am I going to be okay? Am I going to make it? And if you knew the amount of assets we're talking about, it's like, oh yeah, you're gonna be fine.
Yeah.
we don't
You're
even
right.
need we don't even need them to grow. Like
Yeah.
we could get 0% return for the next
Yeah, but still, that's a scary place to
15
be.
years. But Mo, yeah, because when you're disconnected from it, you're not the one controlling it. It's just so many uncertainties because it wasn't like they had a financial planner that combined all. That's what we do every time. I don't care where they have it. I don't care if they've got it at another company. I don't care if they have someone at the bank and they got assets and land. We take the whole picture and we call it the blueprint. And it shows all the assets, how they're labeled, if it's a trust asset, or if it's a business asset, or it's an IRA, and it's all in one simple page. You don't need to be a mathematician. You don't need to read spreadsheets and look through 75 pages. It's one simple page, and it says, this is your net worth. And it's called the blueprint. It's a blueprint to build your house, right? So you can have a little bit of comfort going, oh, when she saw that, it was like,
Yeah.
she brought it and goes, he did really well. And he really cared about me. Yeah, he did. And that's not even including the insurance stuff. That we're getting.
Yeah, that's a sign of true love right there, man. Making sure your loved ones are taken care of after.
Right. Well, it was crazy. I'm sitting here going, well, I'm not sure I would even recommend him get life insurance because of what he had saved and his net worth in real estate and his income. Like he's probably okay.
Don't need it.
But
Yeah.
he did anyways.
Yeah.
I think she got another, what was it, 1.1 or $1.2 million on top of that, and tax free. And it was a great investment too. When you look at what he paid for the premiums, I think he might have paid 60, 70,000 into it and got that back. And when you're looking at all the things, it was overwhelming because now she's got to, change title and, look at the life insurance claims and we were on the phone for hours and hours calling the life insurance companies, and he had a couple of annuities with some other company we had to call, and it was just overwhelming. I mean, there was a couple times she just broke down on the phone crying. She's like, "You're gonna get tired of me crying." I'm like, "No, I actually get that a lot because they just lost their husband, or their, and so it was not necessarily a poor financial position, but the problem was it was so spread out. There was assets all over the place. It's scary because it's like, they've done research on people that they don't clean their room. Have you ever read some of this? They have scatterbrain, right? Like there's clothes and boxes everywhere, and it's not that they don't have enough room. They just don't clean up, and they're literally, their mind is jumbled like that.
Yeah.
And your assets, when they're spread all over the place, you can't really focus. Like that's why I think we add a lot of added peace of mind when someone sees it all in one place for the first time. They've had 2 different advisors, or they've been managed on their own. They got 18 different accounts, and they go, oh, it's all there.
Yeah. You need that focus? Here's a number to call, 866-2-PLAN for 866-TO-PLAN and the number 4.